Hello, welcome everybody. Welcome. Amar, Fitz, Isabella, Jessica, Matthew, Matt, hi, Nick, Oliver, thank you for joining me all today. Looking forward to today's session. I hope you are as well. Still got a few people joining us, but I will jump straight in to today's session and let people in as they join. So I'll try and do both things at once so as not to keep you waiting. So today we're going to be talking all about how to become an investable entrepreneur. So this is the key methodology in my book, and I'm going to be talking you through that today. So for the next hour, you've got me talking through some of the key methodologies that I use, and at the end, hopefully, we'll have some time for some questions as well. So we'll see how we get on time-wise, but hopefully there'll be some time for questions at the end. So for those of you who don't know who I am, I'm James Church. I'm the author of the best-selling book, Investable Entrepreneur, which contains, as I say, the methodologies and the strategies that I'm going to talk to you about today. I'm also the co-founder and the COO at Robot Mascot, and Robot Mascot is the UK's leading pitch agency. We essentially create investment materials that convince investors. And when we do that, our clients become 30 times more likely to raise the investment that they need. And that's why we've been recognised as the UK's leading pitch agency. And it's why we're trusted by the likes of Crowdcube, Seeders, Dent Global, Seed Legals, Swoop Funding, and many, many other capital partners. And people within the startup funding ecosystem all see us as their preferred pitch partner because of the things I'm going to share with you today. Ultimately, at the heart of what we do here at Robot Mascot is that we want to see great ideas and innovations flourish. So we believe that powerful things can happen when great innovation meets inspiring communication. It has the power to change the world, inspire movements, build incredible brands. And ultimately, it's the communication is at the heart of you successfully raising investment. And you're going to learn much more about that today. A couple of questions in the chat already. So yeah, feel free to throw things in the chat as we go. I'll do my best to stop and answer them as we go through today's session. So yes, this is being recorded. It will be on YouTube, the Robot Mascot YouTube channel following this. It will also be available on my LinkedIn feed. I'll put a link to it on my LinkedIn. So connect with me on LinkedIn and get access to the recording. And yeah, welcome everybody. Okay, cheers. So that's the chat. Right, let's jump into the meet. Oh, actually, before I do, thank you to those of you who bought a ticket for good for today's session. Those of you that did, you've helped us fund entrepreneurs in Kenya, female entrepreneurs in Kenya, to create a business that's going to draw themselves and their family out of poverty. We support them with actual capital and finance to help them get off the ground. But we've also supporting them through education that's going to help them build a business and succeed. So it's a really great cause. It's helped over more than 550 women so far, the project that we support, and your tickets for good from today go and help fund that scheme. So I want to start today's session with the idea that there's never been more money available than right now for investment. So despite everything that's going on in the wider economy, there's never been more money available. So the past decade, we've seen unprecedented growth in entrepreneurial investments. We're living in a time and a place that if you've got a £1 billion idea, a multi-million pound idea, there's hundreds of thousands of people out there with the capital to fund it. We've seen the rise in crowdfunding. We've got angel investment has been consistently on the rise for the last decade. We've got VCs, we've got family offices, we've got funds launching all the time. There's whole organizations out there set up with the sole purpose of giving entrepreneurs like you money. And this is the evidence. This is what's been happening over the past 5 years in Europe. So we can see year-on-year growth, even last year, even 2020, with everything that was going on, the pandemics, the bushfires, the plagues of locusts in Africa, despite everything that was going on last year, the global lockdowns, it was a record-breaking year. $41.1 billion invested across Europe. Granted, 2020 wasn't as big a jump as we've seen between sort of 2017, 18 and 19, but it was still, despite everything that was going on, a record-breaking year. So we've seen 150% growth in investments over the past 5 years, and that continues to rise year on year. And there's lots of commentators talking about this pent-up demand. Those that didn't invest in 2020 because they were waiting to see what happened is all being released in 2021. I've already seen this first quarter, or the first couple of months. We're only now in March. The first couple of months is just my LinkedIn feed. I've never seen it with so many investors posting that they want deal flow. Normally it's the other way around. Entrepreneurs posting that they need to be put in touch with investors. It's completely flipped. Investors are desperate for deal flow. They've got money they want to invest. They need to invest it, and they're really, really active at the moment. It's also great that if you're seeking seed rounds, which I'm going to presume that many of you on this session are in that kind of pre-seed seed stage, maybe some Series A as well, but that seed rounds have been increasing year on year as well. So 2020, and again, a record-breaking year for the amount of money invested in the average seed round. So $1.2 million instead of 700K, which it was just a few years ago. So there's more money being invested. There's more money being invested at an earlier stage. So why is this happening, right? So why are we finding, with all the economic uncertainty, more money being invested than ever? Well, what tends to happen, there's a historical precedent for this, is that money flows out of the stock market and into into businesses during times of recession. So in 2008 and 9, when we were in the midst of the credit crunch and the following recession, we saw Airbnb, Uber, Stripe, WhatsApp, Instagram in the UK, companies like Zoopla and Brewdog all get their first major rounds of funding. And now these are all now household names, but they were relatively unknown at the time. But they all got their first major rounds of funding in the midst of that financial crisis. And the same thing is happening again in the midst of this crisis. There's some incredible businesses getting incredible amounts of funding, and some of them will go on to be these unicorns that are household names in a decade's time. So now is a perfect time to be raising investment, because investors are looking for ways to invest their capital that doesn't involve the volatile stock market, because the stock market's really volatile right now. They don't want to put their money in there. It's no good in the bank. We've got the lowest interest rates of all time. So where are they going to put it? Well, they're going to put it into incredible businesses that can see their investments through that downturn and produce an incredible return. They know it's high risk. They also know it's extremely high reward. And the way the stock market is at the moment, that is also extremely high risk, but the rewards are much lower. So they're turning to businesses like yours. But there is a problem, right? Here, the average angel investor sees 10 pitch decks a week, of which one is of interest, and they make on average about 2 investments a year. So that's 520 pitch decks they see every year that they whittle down to just 2 investments. And those investments on average are about £20,000 per investment. So if you're raising 100K, you need 5 investors, 5 average angel investors to invest in you, of which you have to be one of 2 that they've whittled down from 520 pitch decks. So you have to go through that process at least 5 times over to close your round. If you're seeking VC investment, it's a very similar story. They close 1 in every 150 deals that they see. So there's this massive problem in terms of supply and demand. And ultimately, this means that less than 1% of businesses successfully raise investment via angels and VCs combined. So if there is more money than ever, as we can clearly see from the data I presented, why are less than 1% of businesses being funded? It just doesn't make sense. If there's more money than ever, there should be lots of businesses being funded by angels and VCs. So something's getting in the way. Something's getting in the way of entrepreneurs converting that cash. As one investor said to me, there's more money than there are great ideas to fund. So investors are turning around saying, we've got loads of cash, but there's just not enough great ideas to put it into. Yet there's all of these startups. There's 30 or so on this call that are looking for investment. So why aren't they investing? What's going on? So something's getting in the way, and that was what we wanted to find out at Robot Mascot. We knew, and we made it our mission to find out what that was. And that's led to me creating this book, Investable Entrepreneur, and documenting what I've learned through that over the past 5 years or so of doing this job. And fundamentally, the biggest issue is being able to communicate effectively with investors. That's what it all boiled down to. Yes, there was loads of various different reasons: traction, validation, proof of concept, market, team, all of this stuff came up. But ultimately, when you really dug down to it, it was the communication. 80% of the investors that I talked to and I did my research with stated communication was the biggest barrier. Communication of the vision and value proposition, communication of the business case, and the communication of the investment returns that they can expect. So what tends to be happening is you might communicate one of those things quite well. You might be really good at getting people to buy into your vision, but then you don't talk enough about the business case. You don't talk enough about the investment returns. And that's the problem. You're not communicating all of the things you need to tick an investor's boxes and to ultimately have them sign on the dotted line and transfer that cash. So here's what's going on. So let's imagine we've got two people. They look the same, and to an outsider, they may even sound the same. But one's speaking English and the other's speaking French. So they're talking to each other, but things just aren't getting done. They should be working well together. They've each got something the other wants. But they're just not speaking the same language. And this is what's going on between investors and founders. You're talking two entirely different languages. So on one side, you've got the investor that wants to talk about risk, assets, proof, and implementation. Whereas the entrepreneur's natural language is to talk about opportunity, income, possibilities, and ideas. And these two things are at odds with each other, and it's putting up a massive barrier between the investor and the entrepreneur. And ultimately, this is the biggest reason why just 1% of investments are getting, or businesses are getting funded, or investment rounds are closing. So even though there's more money than ever, it's this communication issue between what entrepreneurs talk about and what investors want to hear that's ultimately causing the problem. So when you're talking to an investor who's risk avoidant, when you talk about opportunity, that just sounds scary. When you talk to an investor that wants to hear about the underlying assets in the business, the thing that's actually going to drive the ultimate exit valuation of the business, you talking about income is pretty irrelevant. For an investor that wants to see proof, when you talk about possibilities, it just sounds like long shots. And for an investor that wants to talk implementation, the idea itself isn't so important. So essentially, investors aren't getting their boxes ticked. And because of that, they're not investing. So let's start thinking about who they invest into. So if they're not investing into the 99% of founders, who are the 1% they're investing into? What sets them apart? Now, I call these the investable entrepreneurs. The top 1%, the top few percent of founders out there seeking investment and closing rounds are the investable entrepreneurs. So let me explain what an investable entrepreneur is, what an investable entrepreneur looks like to an investor. So as I said earlier, investors could invest into property, they could invest into the stock market, but many are choosing to invest in entrepreneurs. And that's because they think they'll get astronomical returns. It's high risk, it's high reward. So if a business isn't established, and by that I mean the types of revenues you would see in a company listed on the stock market, for instance, the number one thing an investor is putting their money behind is you, the entrepreneur. Not the concept, not the idea, not the MVP, you, the entrepreneur. So someone like this guy, Elon Musk, he's a great example of an investable entrepreneur. He could have a new idea tomorrow and people would back it without question. He doesn't need a proof of concept to raise millions. His investors don't turn around to him and say, come back when you've got more traction, come back when you've got a better team, because he's an investable entrepreneur. He's proven time and again that if you give him money, he's going to be able to turn it into something of high value. He's going to create a business and he's going to, the share value of that business is going to skyrocket, pardon the pun. It's going to go through the roof. So Elon Musk is an investable entrepreneur, but unfortunately we haven't all got lots of experience with a number of businesses that we've successfully scaled and perhaps exited. So what do we do when we're not Elon Musk? So basically, you need to make sure you look like 3 things to an investor. First, you need to demonstrate to them that you're highly resourceful, that you're able to get people to buy into your vision. So by highly resourceful, I mean you're great at pitching, you're great at getting people to buy into your vision. If you can get investors to buy into your vision, they know that you can get other investors to buy into your vision. You can access capital when you want it. They also know that you can get great talent to come and work for you for below market rate in return for some share options. And you can attract this incredible talent around you. You can get incredible advisors to come and support you. You can open doors with other businesses and create commercial partnerships and channel partnerships that are going to help you scale quickly. All of these things happen to someone who's great at getting people to buy into their vision. And I call them highly resourceful entrepreneurs. It makes you highly resourceful. You can make stuff happen. You can get people to want to work for you and will you to succeed. So if you're not that, you need to find a way to demonstrate that you are. The second thing is that you need to be able to understand, or they need to see that you understand the financial risks. So you have to be able to understand the financial risks in scaling your business so rapidly, that you're not a blind optimist, that you understand and are willing to take those risks yourself. And you're also understanding of the risks you're asking the investor to put into your business and the risks you want the investor to take. So you have to be able to demonstrate you understand those financial risks. And then finally, they're looking for an entrepreneur that understands what commercial success looks like, that they believe that you can build something that's commercially viable and it's going to generate revenue, it's going to generate value in the shares, it's going to generate a return on their investment. They're not looking for someone who can have lots of great ideas. They're looking for someone who can implement those ideas and scale those ideas and ultimately deliver a return on investment. So if an investor turns around and thinks that you're highly resourceful and you understand the financial risks, but you're not, you don't understand how to create commercial success, they're not going to invest. If they think you understand financial risk, you understand commercial success, but you're not highly resourceful, they're not going to invest. And if they think that you understand commercial success and you are highly resourceful, but you don't understand the financial risks, they're not going to invest. It's only when they can see all these 3 things coming together that you successfully raise investment and you position yourself as an investable entrepreneur. So it's only when you're highly resourceful and can get people to buy into your vision. It's only when you can demonstrate that you can understand and quantify the financial risk. And it's only when you have a plan on how you're going to get from where you are now to that potential exit that an entrepreneur becomes investable. So if you're 2 out of these 3 things, there's different names for these people. There's the change maker, there's the asset manager, there's the leader, but none of these people get the type of investment that you're looking for. It's only when these 3 things come together that you get that investable entrepreneur. So the question now is, how do you demonstrate to an investor that you are all 3 of those things? How do you demonstrate that you're an investable entrepreneur? Well, there's 3 critical fundraising assets that you need. The first is the pitch. It's the pitch that determines whether or not you're highly resourceful. That's what they're looking for. That's the main thing they're looking for in your pitch. Are you highly resourceful? It's the first thing that an investor's going to ask for. They want to be able to see that you're great at telling your story, getting people to buy into your vision, that it's clear, it's concise, it's articulate, that people can buy into it, can see the potential in it and want to join you on that journey. They want you to demonstrate you're highly resourceful. The second thing is your projections. Your financial projections are what demonstrate to an investor that you truly understand the financial risk. They want to understand the financial risks that you're asking them to take, as well as the potential rewards. And it's your projections that allow you to do this. And then finally, you need your business plan. It's your business plan that is going to demonstrate that you have the implementation strategy in the short and long term that's going to deliver that commercial success for you, for the investors, for your customers. So I know the vision, I understand the risks, but how do I actually get, or how do you actually get me to that financial reward? How are you going to take my business from where it, or your business, sorry, from where it is now to a key strategic milestone after you've spent my initial investment in the next 12 to 18 months, but then what's going to happen over the next 5 years to deliver me this, this massive return that you're promising me? What are you going to do? Are you going to make strategic acquisitions? Are you going to launch into new markets? Are you going to create new products? Are you developing a product ecosystem? Are you launching into new territories? What is the big long-term plan that's going to get and support the types of revenues that you're going to be creating to justify the type of valuation that gives me a return? So it's these three things that demonstrate that you're an investable entrepreneur to an investor. So if you don't have the right pitch, it's not backed up by credible financial forecasts and a believable business strategy. If these three things aren't in place, the investor just isn't going to view you as an investable entrepreneur. You're paddling upstream. You're not giving yourself the best opportunity and the best chance of securing the investor's support. So let me just talk through and quickly share with you a top level overview of those funding assets. So the things that you're going to need to create within each of those three categories to best place you to convince investors that your business is the one to back. It's the investable entrepreneur toolkit, if you will. It's the set of materials, the set of artillery that you need to go and pitch to investors. So let's start at the bottom. Let's start at that plan, because everything should be built upon this. Your pitch, your projections, everything is built and around your strategic plan. This is how you're going to convince an investor that you're set up for commercial success. So your plan is going to have to consist of things like your medium and long-term plan, as I mentioned. What are you going to do over the next 12 to 18 months? What are you going to do over the next 5 years to deliver me that return? You're also going to need your market research. And by that, I mean, what size is your market? How many competitors are there? What validation do you have? Have you achieved product market fit? What are the market risks and opportunities? All of these things need to be discussed. You're going to need to talk about your marketing or your go-to-market strategy. So investors know that after access to capital, the second biggest killer of startups is their ability to actually market and sell what they've created. So if I'm sitting there as an investor, I'm looking for the type of founder that understands how to take this to market, understands how to scale this up through smart marketing strategies that deliver high value for low cost. So unless you've really considered how you're actually going to take this to market, then you're a high risk investment. You're not reducing your potential risk to an investor by being clear on how you're going to take this product to market or scale this product. Because I know that's after I give you money, the reason you're going to fail is because of this. So you have to get really clear and really good at talking about how you're going to scale this product. You're also going to want to touch on your investment objectives. So key tangible things that the investors can talk to you about with regards to your how you're going to spend the money and what they're going to see at the end of that. So what some kind of measurable objective. We'll have launched our MVP. We'll have reached 1 million customers. We'll have achieved X, Y, and Z. Something that they can look back on and they can measure you against. Now, that doesn't mean that they're actually going to look back and measure you on this, although many will. But it's more of a case of stating up front that we're going to have an open and honest relationship with you. We're going to keep you abreast. We know what of the detail. We know what we're looking to achieve. We're going to hit these milestones or exceed them. And hopefully you exceed them, and then you go back for your next round of investment, and your investors want to follow on because you've proven that you can deliver when you give them money. So that sets up the type of relationship you're going to have with an investor. If you don't talk about it, I'm starting to wonder whether you're going to actually keep me up to date with the progress of the company. You're going to want to talk about your exit plan. How are you going to exit the company? What's your current thinking around exit? What does that valuation look like? What does the day of exit scenario look like? How big will the company be? How many staff will there be? What's your turnover like? What's your profits? What key metrics, performance metrics do you expect? What increase are they going to see in the share value? So you're going to buy shares at £7 a share today, and they're going to be worth £700 a share by the time we exit. All of these things help paint the picture of what it is that an investor is buying into. Because remember, they're buying an unfinished product, essentially. It's like buying into a block of flats before the block of flats have been built. If you're going to do that, if you're buying a house off plan, you go to a marketing suite, you see visualizations of what it's going to look like on the inside and the outside. You're going to see pictures of what the view from your window would look like. They're going to have this brochure that mocks up what it looks like, this thing that you're about to buy that hasn't even been built yet. And that's exactly the same with your company. It's not built yet. It's not ready yet. It's not the finished product. I'm buying it now based on the potential of what it will become. So do your best to paint the picture of the potential of what it will become. You're going to need your business valuation as well. Some clear, data-driven way of valuing your business rather than just a finger in the air guess. You want to research that and come to a firm conclusion on what your business valuation is. So that's the plan. Once you've got all of this in place, creating the projections and the pitch become much easier because you're really building this around a strategy. When it comes to your projections, there's 5 assets you're going to need. You're going to need your income and expenditure. You're going to need your cash flow, your rolling balance sheet. You're going to need some key metrics and a financial summary, and you're going to need your financial commentary. Ultimately, these things together are going to allow an investor to see the potential risks, the potential rewards, as well as the underlying valuable assets in the business. So your P&L is fairly self-explanatory. Your cash flow is going to really tell an investor how you're going to manage this business financially. So are you essentially running the account to zero before you raise your next round of investment? Or is there, based on your burn rate, is there 2 or 3 months buffer built into that plan? Have you got 2 or 3 months cash left before your next round of investment will land in your account? Because if that's delayed, what happens if you run your account to zero? How sensibly are you managing that? Because if you're running it to zero, if that second funding round's delayed, then you're screwed. It's game over. Equally, it's going to tell you how much investment you actually need. You'll be able to see, based on your income, based on your expenditure and the delays in various payments, because your income and expenditure, your P&L is going to show income when it's invoiced, not when it lands in your bank account, whereas the cash flow is making a prediction of when that income actually lands in your bank account, when that expense actually leaves your bank account. You're going to be able to see your cash flow deficit, and that's how much money you need to raise. If your lowest cash point is 750k, then you need 750k. Well, probably you need 1 million, so you've got some wiggle room in case things cost a bit more or things take a bit longer. Your rolling balance sheet is the same thing, but based on the assets within the company. Your cash, your liabilities, what people owe you, what you owe other people. It will tell investors on a rolling month-by-month basis what the equity in the business is worth. So in a worst case scenario, if you had to wind down the business, how much physical equity is there in the business? Key metrics and financial summary. Investable entrepreneurs want to be able to turn around to an investor and say, we understand what you're looking for. We speak the same language. We can do really well together in business. We understand you're looking for these key metrics. So I've presented them all in a financial summary. I'm not asking you to go through and calculate my churn rate, calculate my cost per acquisition, my revenue per staff. I'm not expecting you to go and calculate all of these things for each year. What I've done is I've pulled these out front. I've got a table of metrics, performance metrics for the next 5 years of my forecast, so you can quickly see the performance of my business. Now, these are vital because they basically are going to quickly tell an investor how credible your financials are. So a great example is revenue per staff. So how much revenue are you going to make per member of staff? The average in the UK is around 135k. Netflix earn $1 million for every member of staff they have, and Amazon are somewhere in the middle, 400k for every member of staff they have. They've got a lot of warehousing staff that they need to employ, so it's more hands-on than a tech platform like Netflix. So if I look at your year 5 forecast and you're making 3 million revenue for every member of staff, you're outperforming companies like Netflix. You're outperforming Amazon by a long, long way. And I'm asking myself, is that realistic? Is it realistic to outperform some of these, some of the best in the industry when it comes to those metrics by that much? Or is it actually the case that you haven't budgeted for enough staff? So therefore, that profit you're telling me you're going to make in year 5 must be wrong. Your valuation, your exit valuation is based on a multiple of that profit. Say 5 or 10 times your profit is how much your company would sell for when you exit. So if your profit is wrong, that exit valuation is wrong. And if your exit valuation is wrong, the return on investment you're promising me is also wrong. So very quickly, by looking at one metric, the whole thing starts to fall apart and the whole thing loses credibility. So investable entrepreneurs know that their financials are spot on. So they pull these metrics out front and they're really proud of them and say, look, everything's in order. Pull that apart if you like, but we know that everything's in order. If we hit these goals, we're going to deliver the type of return for you, and we've budgeted for everything, we've thought of everything. A financial commentary is super useful, a one-page kind of written document just to explain what they're about to see in the financial projections. You don't have to have it. We always provide one at Robot Mascot for our clients. It does a really good job of saying these financials are being validated by an external third party, rather than just the thoughts and the feelings and the emotions of a founder that tend to overestimate revenue and underestimate costs typically. So it just gives a bit of additional credibility. But if you're doing them yourself, it's well worth just having a quick rundown of the key assumptions these are based on, the key pullouts from that you want to draw investors' attention to from the spreadsheet. So they've got a bit of an idea of what they're going to look at before they get into the nitty-gritty of the spreadsheets. So that's your projection assets. Your pitch assets, this is all about demonstrating that you're highly resourceful. There's actually 5 types of pitch asset that we've identified come up regularly in the best campaigns, the top campaigns that close rounds. The first is the investor pitch. This is your standard 15 to 20 slide investor pitch that you could email an investor, they could read through it. You wouldn't need to be there to explain anything. It's the most brochure-esque form of your pitch. Nowhere near as wordy as a brochure, but it makes sense on its own without you needing to be there to explain everything. 50 to 75 words a slide, ideally. You then have your teaser pitch. This is a 10-slide version, sometimes called a product pitch or a product deck. It's essentially an overview of your investor pitch. It's just the vision and the value proposition. It's just sort of 10 slides, really focusing in on the vision, the value proposition, getting people to buy into your idea, making yourself very highly resourceful. We're not talking about strategy. We'll talk about that at a later date. This is what we're trying to achieve. So this works really well with cold emails to investors. You can do your research. You say to them, look, I see that you've invested in similar businesses to mine at a similar stage. I think we could be of real interest to you. Please find attached, or please find a link to an overview of what we're trying to achieve at Company X. If this is something that you feel would be of interest to you, I'd love to arrange a time to either present to you our concept and our full investor pitch, or I can send you a copy of our investor pitch and for you to look through in more detail. You're just getting them excited by the vision and the idea. You're getting that emotional buy-in first. And if you've got their emotional buy-in, when it comes to presenting to them, you have much more constructive conversations with that investor, rather than them just going, no, that's never going to work. they're already emotionally bought into this idea. They'd love it, they like what you're doing, they're interested in the concept. So then they're much more constructive when they talk to you, and you end up having much greater, more in-depth conversations and build better relationships, and ultimately your close rate becomes much higher. Your presentation pitch is a cut down version of your investor pitch. Slides a bit like this slide, with just a few words on a slide, and you fill in the rest of the content with your own narrative. So just a visual cue for you as to what you should be talking about, and also a visual cue for the investor so they can follow the story and pick up on key points and better remember those key points. The one pager is the opposite to the teaser pitch. It's your business plan on a page. It's really just a top level summary of the strategic side of the pitch. Again, I tend to suggest not to lead on sending the one pager, because there's no emotional connection. They might just look at it and say, that doesn't seem to make sense, and it's out the window. There's no emotional connection. Sometimes you'll send your teaser pitch to an investor. They'll want to see your one pager before they'll commit to having a presentation with you. That's fine. You've already started to have that emotional connection with them. Sometimes the one pager is asked for as part of your application to an angel group or a VC firm, or some, if you're looking for grants, often that's asked for. So it's useful to have for when people ask for it, but I tend to suggest not to lead on sending the one pager, and you're better off sending the teaser pitch first. The expression of interest form is a really underutilized tool, but it puts you in control, of the negotiations. So what you can do, and what the best founders do, is they treat this like a sales process. So if you get a verbal commitment from an investor, ask them to fill out an expression of interest form. Put that down in writing. It's not heads of terms. It's something in between, from that verbal commitment to just something down in writing. You can then call back those investors. So let's say you're raising 500K. Once you've got 750K of expressions of interest, you can ring back those investors, and you can say, I'm oversubscribed. I've got more investors wanting to invest in this round than I need. I've got 750K committed. You'll remember, I'm only looking for 500K. Are you in? Doesn't matter if you're not, because I've got other investors who are interested, but I really wanted to give you the opportunity because I thought we had a really good rapport. You could bring X, Y, and Z to the table, as well as cash, whatever it may be. But you can then put them in, you can control that conversation. Investors are suckers for FOMO. They hate the fear of missing out. So if there's other investors who are wanting to be part of this, and they've seen the opportunity that they saw in it too, then 9 times out of 10, 99 times out of 100, the investor's in. Unless something's happened and they've suddenly got no money to invest, they're in. So the expression of interest form just gives you that little bit of control over the process. So that's the gist of becoming an investable entrepreneur. Once you've got those assets in place, your pitch, your plan, your projections, what you're doing is you're essentially signaling to investors that you're an investable entrepreneur and that you can be trusted with their money. So remember, I said at the very beginning, there's more money than ever, and there still will be. These investors are essentially just sitting on top of a massive pile of cash. And it's fair to think that in the current situation, money might, you might think money's the most valuable thing. People are wanting to keep hold of money at the moment. But when you're an investor and you have all this money sitting behind you, it's there and it needs to be deployed. They have to protect their wealth. It's no good in the bank. They have to get a return. So all they're trying to do is identify a good risk. They're trying to identify a good entrepreneur to invest into. And it's your job to de-risk that as much as possible. De-risk yourself as an investment versus every other founder on the market as much as possible. And that those that do, and do so through creating assets like I just described, are the 1% of founders who are succeeding. So you have to demonstrate you're something special. You have to demonstrate you're an investable entrepreneur if you want to be in that elite category. So unless an investor can look at you and see that you demonstrate these 3 things, that you're highly resourceful, that you understand the risks, that you understand commercial success, they're just not going to invest. And in the language of an investor, the way that we see those things is through the financial projections, through the business plan, and through the pitch materials. Once you've got those things together, You really start to put yourself in that top few percent of founders who are out there seeking investment, and your chances of securing and closing your deal go through the roof. Like I say, our clients are 30 times more likely than the average founder because they have these assets in place. But there are some additional things that you need to know. So before I finish, I just want to zoom out for a second. And I'd like us to look at just some 4 key strategic focuses that you need to be aware of if you're thinking of raising investment. So in addition to these assets, the first thing I want to draw your attention to is the fundraising journey. So it's very easy to focus on the short term, the here and now. But investors need you to have a good understanding of what you plan to achieve over the next 3 to 5 years. So they want you to think with the exit in mind. It's the exit that is how they realize that return, not through dividends, but through the sale of those shares. So here's a typical kind of fundraising journey for a business. So they start with negative profits. They're in what we call here the wilderness, and their profits are negative. They're bootstrapping. They've got friends and family, a pre-seed round. They're spending more money than they're making. They don't even have a product to the market yet. Then they start to begin to generate revenues, and their profit starts to increase and head towards zero, a break-even point. And then they start to rapidly scale, and their profits start to grow. So as that growth sort of begins to slow, so as you can see that as your growth starts to begin to slow, that's often a good time to start exiting. You want to exit just as you know that you've done as much as you can. The trend is going upwards. You know you're starting to hit some kind of ceiling. That's your best time to exit. You've grown at a fast pace. It looks exciting, and then exit at that point. So it could be that there's many rounds of investment needed along the way. So you might not do all of these. The average is about 3 rounds of investment between founding a company and an exit. But you might do a friends and family round, a pre-seed round. These are typically rounds reserved for sort of pre-revenue businesses, under $1 million normally. Then you've got your seed round, your Series A, Series B. These are slightly later stage. So seed is more when you're starting to generate revenues, but you're probably still not making a profit. And then your series round, Series A, Series B, Series C, are more when you're making profit, you're rapidly scaling. And you may need all of those. You may only need some. Like if we go back to Elon Musk, his SpaceX is currently on a Series J round, I think. They just keep going and keep going. Like I say, most businesses raise 3 rounds of investment, or most high-tech scale-up businesses raise 3 rounds before they exit. It's nearly always better to raise less money more often. Building assets within the business, improving your market position, increasing your valuation between each round. And that way you can revalue your company between each round, and you can raise again a larger valuation, and you can get more money for less equity in the long term. So if you want to make sure you retain as much equity as possible, it's normally better, and it's not always the case, but it's normally better to do a number of smaller rounds than it is to do one big large one straight away. So think about how many rounds of investment you actually need. How much money do you actually need right now? Could you just raise 9 or 12 months worth of cash instead of 2 years worth of cash, and do a second round later at a higher valuation and raise the same money again or more for less equity? So that's the fundraising journey. You need to have a really good understanding of what that looks like for you as you go through that bootstrap, startup, scale up and exit phase. So really consider what you're going to need over the long term and what's realistic. The next thing I want to draw your attention to is that you need to understand the current investor trends in the light of COVID-19. You obviously, this is a big consideration for everybody right now. So I want to share with you some 3 key trends that I've spotted over the last year or so. So I've been speaking with investors constantly over the last year, And I can pretty much categorize everything they say they're looking for in response to COVID-19 into three main categories. The first is changing markets, changing behaviors, and changing timescales. By changing markets, I mean, how is the wider market, the wider economy, but also your niche changing because of the pandemic? And what does that mean for you in terms of what risks does it pose and how are you going to mitigate those risks? And what opportunities does it create and how are you going to take advantage of them? The same with changing behaviors. We've all changed our behaviors. We're happy doing Zoom calls like this rather than physical events. Buying behaviors have changed. Consumer behavior has changed. I think possibly since the first time since the Industrial Revolution, it's actually a case of human behaviors dictating change in technology and not the other way around. Normally we innovate, we have our early adopters, we have our majority, and then we have our laggards who follow up in the rear and finally adopt that technology you've been using for 10 years. In this case, we're 10 years ahead of where we should be. We've been thrown into this virtual world and technology is trying to catch up. So how does that affect your business? Again, what risks are there that you need to mitigate? What opportunities are there that you can take advantage of when it comes to your customers and their buying behaviors? And then the final thing is timescales. There's no way, or there's very little chance that you haven't been affected in some way again with regards to COVID, and that's probably had an impact on your timelines. You're having to homeschool kids and you just can't get stuff done as quickly. You can't get in the office and the team are separated. So you've lost 3 months while you try and set up your remote working operations. Or it's something more fundamental. Your product is needed now, and now is a perfect time to release your product, not in 12 months time when you were expecting to, because you were going to go through this kind of lengthy R&D phase. It's actually the market needs it right now. So I need more investment now to take advantage of this unique situation that I'm in. Or it might be that actually you need to pivot your product for what the future is going to look like. And you need to spend an extra 6 months in R&D pivoting your product. And it's not going to be best to launch to the market now, and you'll be better launching to the market in 6 to 12 months time. And it gives you more chance to do more research, validation, soft launches, soft testing to get a better product to the market that's the right type of product for the new type of world that we're going to live in. So how are changing timescales affecting your business? And again, risks and opportunities. Being able to talk about these things with investors is going to massively increase your credibility. It's going to make sure you explain them in your strategy, put them in that business plan I talked about. Talk about changing markets, changing behaviors, and changing timescales. Have a whole section in your business plan if you need to, just talking about these three things and what you're going to do about it. Next, I just want to cover how you create investor demand. So I do a whole hour on this called How to Make Investors Love You. But the key thing to realize is that raising investment is a full-time job on top of your full-time job of building a business. You have to be absolutely 100% dedicated to raising investment. You have to commit to it, and you have to treat it like a business-to-business sales process. Track your leads, generate leads, convert them into presentations, convert them into sales, convert them into investments. So you have to be able to create investor demand. And in summary, I use the 30-10-2-1 rule. So investable entrepreneurs who have all the assets in place generally work to a 30-10-2-1 rule. So for every 30 investors you outreach to, you'll secure yourself 10 pitch opportunities. From those 10 pitch opportunities, 2 investors will express interest and fill out your expression of interest form. And of those, 1 will end up converting and actually signing on the dotted line, signing the terms, going through the due diligence and dropping the money into your account. So you need to develop strategies that are going to do that. So, and you can develop strategies to fast track that. So you can start pitching one-to-many. Everyone pitches one-to-one to investors. Why not? Why not pitch one-to-many? Why not contact loads of investors that you've done your research on and you know would be interested in this deal, and invite them to 3 or 4 pitch events where you're going to have 10, 20, 30 investors in each Zoom call. They're going to see there's loads of interest. Remember, I said they miss out on it. They hate the idea of missing out. So the fact that you've got all of this interest is going to create a buzz. And with every pitch of 30 investors, you should end up securing yourself one investor. So you can actually pitch one-to-many rather than having to have all of this laborious task of one-to-one meetings. So a lot of our clients have done that and had a tremendous success, especially in the angel stage when pitching to angel investors and getting rooms of 10, 20 potential investors together and pitching one-to-many and creating that buzz. So you've got to be able to create investor demand. It's a bit like building a website. You could have the best e-commerce website on the planet. If you don't market it, you're never going to make any sales. And it's the same. You could have the best idea, the best product, the best strategy, the best pitch assets. If you're not prepared to go and create investor demand, you're not going to secure investment. The final thing, before we open this out to 5 minutes of questions, is to understand the investable entrepreneur mindset. There's 3 key things: relentlessness, confidence, and conviction. So you're going to need to be confident in what you're doing. You need to be confident in your strategy, in your business, in the way you're going to deliver a return to an investor, because you're opening yourself up to scrutiny. You may even feel like you're going around with a begging bowl in your hands, begging for money. That's not the case. The assets you produce have a knock-on effect to your confidence. If you're really proud of your strategy, you think it ticks all the boxes, everything has been considered, it's going to work, it's based on evidence, we've worked with people who understand how this stuff works, and we've got this really great strategy. Suddenly you feel like a proper entrepreneur, not just someone with a great idea, but a real business person with a strategy of how I'm actually going to deliver a return for myself and my investors. So you get more confidence in yourself, more confidence in your business, and investors are going to be lucky to have the opportunity to invest. That's how an investable entrepreneur feels when they go out and pitch. Not, I'm hopeful this investor is going to invest in me. It's, this investor will be lucky to be on the journey that I'm offering to them. That's the difference. Relentlessness. Right? This is this might be your first time raising investment. So you're bound to make some mistakes along the way. Just like when you started your first business, or maybe this is your first business, you'll have made lots of mistakes along the way. And if we were to start again, you would not make those mistakes and you'd get to where you are now 10 times quicker. Investable entrepreneurs are the ones that get back up from the knockdowns, they learn from their mistakes and they keep going. So someone I mentioned in my book, a chap called Tony, as far as we're aware, he holds and his colleagues hold the record for the largest seed round in the UK, a £65 million seed round. It took him 3 years of pitching to find the right investors. Unsurprisingly, asking for that much money without even a proof of concept. He had nailed his business plan. He'd nailed his financial projections. He'd nailed his pitch. He knew he was going to need to pitch to private equity firms, not angel investors, and they had absolutely nailed the strategy with them in mind. But it still took them 3 years of knocking on doors, opening, pitching, and being told to do 65 million is ridiculous. Now, you could have gone away and he could have completely changed his strategy. He could have said, oh, we'll try and bootstrap this, we'll try and do this. But he knew that if he was going to make this business a success, it was go big or go home. And he was looking for the investor that was willing to take that risk and see the opportunity. And after 3 years of pitching, he found it. He was relentless. He was an investable entrepreneur. Now, I'm not saying you need to be out there pitching for 3 years for 65 million, but you get the point. You need to have faith in what you're doing and keep going, keep knocking down those doors and get this done. And finally, conviction. Like I said, you're going to have lots of knockbacks. The ratio, 30 outreaches to one investment. 29 people are going to tell you no for every one investor that you secure. So you have to have conviction. You can't think that what you're doing is wrong or what you're pitching is wrong or the business strategy is wrong because 29 people don't agree with you. Because whatever you present, that's going to be the ratio. There's going to be 29 people for every one you secure that don't see the potential in the idea, or don't think you're at the right stage right now, or that you need to do more of this or more of that. But if you keep going, if you've got conviction, you will find the investors that you need to close the deal. You just need to understand that that's going to happen. As soon as you realize that, it doesn't matter that 29 people say no. You just need to go and ask another 30 people to find your second investor. So you have to have that conviction that what you're doing is the right thing. You have to have that courage to keep going. And you have to remember, you know your business and your strategy better than anyone else, right? It's your business. You know how you're going to scale this better than an investor who's read a pitch document and heard you present for 5 minutes. What do they know about how you're going to build and scale this business? You have to have conviction in your own ability to make this happen. And that brings us towards the end of the session. So for those of you who haven't read it, I've given you pretty much a bite-sized review of overview of my book, but the full details of everything that I've talked about is in my book, Investable Entrepreneur. So feel free to grab yourself a copy. If you're seeking looking to raise investment in the next 3 to 12 months, or maybe immediately, it's probably worth you benchmarking your current ability to raise investment using our Pitch Ready scorecard. Answer just a few multiple choice questions. It takes less than 5 minutes, and you'll get a free 12-page report that details how well you're performing against each of those assets that I suggested that make up the Investable Entrepreneur formula. So you'll be able to see how well you're doing and where you need to add value. Connect with me on LinkedIn. Or join my Facebook group, Investable Entrepreneur, if you want to hear more about this. But for now, we've got a few minutes left, so happy to open it out to some questions if anyone has any. What have we got? Have we got anything in the chat? The average equity, yeah. It really depends. So some entrepreneurs are left with 10%, 15%, and they've gone through a number of rounds, but that 10-15% is worth millions. There's plenty of others that are left with over 50% because they've done 3 rounds of investment. The average, if you raise the right amount and you plan your fundraising journey in the right way, the average should be 15% equity sold at each round. 3 rounds means that you should end up with 55% equity yourself, 45% with investors, and then you exit. That's the theory. It doesn't obviously always work out like that, but that's based on the averages from our partner Seed Legals and what they see go through their platform. So yeah, anything from 50% to 10%. In some horrible cases, the way that, you have to talk to Seed Legals about this, but certain types of shares end up meaning that you exit the business and you actually end up owing your investors some money. So be really careful about the types of shares you give away. And that's why you need someone like Seed Legals on board. US entrepreneurs are expected to talk to close to 300 investors to get their funding. So yeah, there we go. 300 investors, 10 investors, close your round. Great. Awesome, Ori. Advanced subscription agreements instead of a formal funding round. Yeah, really can be great, can be really great, because it allows you to get money in now and worry about the valuation of your company later. So a lot of our clients in the sort of pre-seed stage, you look at how much investment you need over the next 12 months. And because you're maybe spending 6 months doing some product development, maybe you only need 200K to see you through the next 6 months and get that MVP to market. But that's when you start having to market and start having to bring in a marketing team and a marketing budget, and suddenly your costs start to spiral. So maybe your 12 to 18 month fundraise might be nearer $1 million, but you only actually need 200K in the first 6 months. So in those sorts of situations, a convertible note, an advanced subscription agreement, a seed fast, whatever you want to call it, can be really a really great strategy, because you're in a position where you're going to get that initial money in to start moving, get some proof points based on a future valuation, having spend that money on a tangible asset like an MVP, which allows you to revalue your company. So yeah, they can be really, really great. What else have we got here? Do strategies differ from country to country? Not massively, continent to continent. So European investors, British investors, very similar to each other, much more risk averse, generally more British about it. America, you can tend to raise a bit more for less equity in the earlier stages with less evidence and less proof and less traction. Failure isn't considered in the same sense as it is in Europe. So failure is often a positive thing, seen as a positive learning curve in America, whereas it's really seen as a failure in the UK and Europe. So there's some slight differences, but generally speaking, what I talked about today applies. It's all about de-risking yourself versus everyone else. And all of these things I talked about today help you de-risk yourself versus everybody else. How is it possible you can own money on exit? In that case, why exit at all? Yeah. So I knew I shouldn't have said that because I'm sure it'll get some of you. So there's, I can't remember exactly what the terminology is, but there's basically different classes of share. You can have certain classes of share that VCs often ask for. That means that they get paid back. They get paid back as a priority. So if you are exiting your business, those shares might have promised them a certain amount of return, and therefore if you exit your business and it's not going to deliver a return or deliver that return, you might end up owing them money. It's a scare story that I know Seed Legals use a lot, so go and talk to Anthony at Seed Legals about it. He's got a great story and he's much better articulating it than me, but it has happened. It's just about the legal agreement and the different classes of share that you issue to different investors that have different rules to them. So yeah, just watch out for it. It doesn't happen very often, but just watch out for it. The numbers on the side of each bar. So the top number was the company valuation at that stage. The next line down is the share of ownership and how much, and then the third one is what that value is. So something we didn't talk about was how, owning 20% of a 200 million pound company gives you 40 million, your share value of 40 million, whereas owning 100% of a company worth 200k only gives you 200k. So those just talk about how your value increases, and while your equity may drop, your actual, how much your shares are worth and more. So cool. Right, well, I'm gonna end it there, everyone. Thanks so much for joining me today. I hope you got a lot out of it, and like I say, pick up a copy of the book. There's a free PDF download of that on the Robot Mascot website if you want to go there. And if you want a Kindle or paperback version, it's obviously on Amazon. And take the scorecard, see where you are and see where you need to work on your assets and start building that ecosystem of assets that are going to give you the best success for raising investment. So that's everything from me, guys. Thanks a lot for joining me. We'll see you in a couple of weeks. I think we've got another event on in a couple of weeks with Seeders, who are going to talk about how to run a crowdfunding campaign. So that's something you're thinking of doing. Join us then. But otherwise, it's all from me, and see you all later.